Good morning. Today is February 10th, 2022. I'm Joe Terrell, president of Terrell & Company, Independent Wealth Managers in St. Louis, Missouri. This is another video update for our clients and associates and other people that follow our thoughts about the economy and investments. Those that have seen our previous videos, and certainly our clients know, we've been talking for the last 18 months about inflation and what effect that ultimately will have on the economy as well as investment markets. This morning's figure showing that year-over-year inflation was 7.5% certainly confirms our belief that we have had on inflation, that it is going high, and the Federal Reserve Bank of the United States needs to deal with this sooner and more aggressively than certainly what their schedule appears to be. This is not only inflation in the United States, but inflation around the world. If you think of it this way, this is the payback for years worth of easy money and money printing all over the world by industrialized countries, whether it's been Europe, Japan. You cannot just simply print new money without debasing the value of existing money. So a couple of thoughts as we lead into hopefully an early coming of spring. You're going to see the economy be much stronger than certainly what markets around the world are anticipating. The markets believe an increase in a 10-year government bond yield from 1.5% to 2.5% or 3% will cause a recession, and you're going to see prices then radically come down as we enter in a recession. That's wrong. That's not going to happen. You will see a strong economy for the very reason that interest rates at 2.5% or 3% with inflation running at 7% is not going to discourage anybody from buying, borrowing, and participating in the economy around the world. So where markets are also wrong, and a lot of investors are wrong, they look at commodity prices, and some people are saying we've reached peak inflation because they see the price of used cars stabilizing, coming down. They see the price of steel coming down $400 or $500 a ton. This inflation has nothing to do with commodity prices. It's not commodity prices that are causing inflation to go up. It's excessive money printing by central bankers around the world. My demonstration of this is if you'll simply look at the price of soybeans and corn. Soybeans are almost $17 a bushel. Corn is threatening to be $7 a bushel. There's no shortage of corn or soybeans, and there certainly isn't any supply chain disruption problems that as soon as that changes, prices will come back down. Food prices, as well as labor cost, as well as the cost of housing, is just beginning to affect inflation. So we see inflation continuing at these levels throughout 2022. We see the Fed getting punched in the nose later this year and realizing they need to be more aggressive in raising interest rates and certainly they need to raise them higher than what the markets currently believe. So, with this said, we'll see a strong economy, we'll see higher interest rates, and we're definitely going to see inflation continue at these levels. We at Taro & Company are invested for higher interest rates. You must stay away from fixed income in the bond market. You'll get huge negative returns in that throughout 22 and into 23. With stocks, you must be very selective. All of the speculative stocks on the NASDAQ and other places that were very popular in 2021, they're already being taken apart, down 40, 50% off their highs. That will continue. We and a person needs to be invested in industrial stocks that have the ability to raise prices and are in businesses that are a necessity. We still like fertilizer stocks, we still like packaging companies, we definitely continue to like the energy area, and we like financials that'll benefit from interest rates moving higher. So with that said, Brian Curtis, who helps us with this, let's be back. Today's the 10th. Maybe we'll be back at the end of February with another video update. So thank you for joining us today, and we'll see you at the end of February.